Hey everyone, it's Jeff Trapp here with the Jeff Trapp podcast. And thank you so much for joining me today. We are finally through tax season. And this is one of my most favorite times of year because now we're into the extension season, but we're really in the throes of what we call tax planning season. A lot of times people think, oh, I can only save money on taxes at the end of the tax year. And that is the wrong line of thinking. You need to be proactively planning what you're going to do right now, today, during this tax year to save money on taxes for 2025. And if you're just waiting until the end of the year to do something, then all of the best strategies are going out the window. Whether you're a business owner, you're a high net worth individual, high W-2, you need to start planning what you're going to do for 2025 taxes, which brings me to what I want to cover a little bit today. A lot of folks are really worried about what is happening in 2025, what is going on with the economy and tariffs and the stock market and gas prices and all the things. So I want to address that today, and then also go into kind of an archive here from some questions that I get from our listeners. And I have a really good one that I want to cover today. So I'm super excited to talk about that. So what is going on out there in the news, right? So we've had tariffs that have come into play on April the 2nd. The stock market went down for about a week, and now it's starting to rally a little bit as different countries are starting to negotiate here at the United States. We're, pausing some tariffs for 90 days and things like that. And, what I advise my clients, to kind of during this tumultuous time where there's a lot of volatility is, stay the course, ride things out through the losses, through the ups and downs. And remember, the stock market isn't an indicator of how the economy is doing, right? Because a lot of us have money in the stock market, but that money is in our 401ks, right? We don't live off that money on a daily basis. Yes, we want the stock market to be high when we retire and pull that money out. But a lot of times what they've seen is folks will pull money out of the stock market when it goes down to a time when they feel more comfortable. Well, when they feel more comfortable is when the stock market's up again. And a lot of times they've lost that money or that gain. And so you definitely don't want to do that, right? And, why do we have tariffs? What is going on? What's the driver behind that? And really the driver behind that is to help bring inflation down, help fix the trade deficit, right? And to get the Fed to cut interest rates, right? We have really, really high interest rates, which basically has collapsed the real estate market and the mortgage industry for the last few years, right? And, at the beginning of the year, the Fed said, hey, we're going to cut rates maybe 1 to 2 times this year. Well, as soon as we do the tariffs, right? President Trump does the tariffs, they're talking about cutting rates 4 to 5 times this year. And so that will bring the cost of borrowing down for consumers. We've already seen oil prices drop and dip considerably, right? And so the cost of things are going down a little bit right now. And so we'll continue to monitor that and see what happens there. I don't know if it's going to be good or bad long term. I don't have a crystal ball here. But I encourage you to do is just focus on your economy and focus on getting your finances right, getting your tax plan in place, right? We always advise our business and individual clients to keep a 6-month cash reserve, liquid cash, individually and in your business. So in case things do become really volatile, you have money to pay for your living expenses, for your business expenses, and focus on scaling and growing your business, growing and scaling your income. Focus on setting money aside for you. So those are some things to consider as we go through the ups and downs and the volatility of tariffs and stock markets and all the things over the next several months. And we'll keep you apprised on what's going on out there. Now, something else that's really exciting is the House passed a budget reconciliation act that went to the Senate. That has gone back now to the House as they made some changes to that, but that includes our tax law changes, right? The big change would be the extension of the Trump era tax cuts. And hopefully bring back that 100% bonus depreciation. So if you buy qualifying equipment, furniture, fixtures, qualifying leasehold improvements, if you own real estate, and those heavy SUVs that everybody loves, those G-Wagons and Range Rovers, that 6,000 pounds gross vehicle weight, where you get 100% write-off, that is supposedly supposed to be in this iteration of the bill. So that's really, really exciting, right? So there may be some things that you can do with that. So with that being said, we are in the extension tax planning season. If you filed an extension, then you don't really need to file your tax returns till, September for a business, September 15th. If you're personal, October 15th. And there have been some additional delays in things related to weather and disaster relief. So I encourage you to check out the IRS website for that. So I just want to dive into a quick kind of tax strategy or something to kind of think about. We get a lot of folks that say, hey, Jeff, I want to pay less in taxes. I'm ready to invest in real estate, right? And, a lot of times just because you want to invest in real estate doesn't mean it's like a magic wand all of a sudden to be able to take all those losses, right? Because, when you invest in real estate, and if you're not considered what they call a quote unquote real estate professional, well, those are passive losses, and passive losses, unfortunately, can only offset passive income. So they stay frozen, they stay locked up. They don't automatically become deductible against your W-2 income or capital gains, your business income, or things like that. And so you're going to want to have some passive income to offset with those passive losses, and they get what they call suspended. So how do I qualify, right, as a real estate professional? Well, you have to spend more than 50% of your time working in real estate trades or businesses and log at least 750 hours per year in those activities. Oh, and you must materially participate in your rentals, meaning you actively involved in managing them. So if you meet all three, you can treat your rental losses as non-passive and deduct them against your W-2 income, your business income. Now, keep in mind, you've got to meet that 50% rule. So you got to work, one more minute in the real estate business than you do maybe in your IT business, right? So those are a few things to keep in mind, and you must qualify every single year. Now, a question we get a lot is like, hey, Jeff, I qualified as a real estate professional this year. I know I didn't prior 4 or 5 years. What happens with all those losses? Can I take those to offset some of my income, right? Can I free those up? Can I free up those old losses now that I'm a real estate professional, offset my W-2 income, offset my business income? And unfortunately, those stay passive, and you could only use those if you have passive income to offset them. You earn income from the same rental activity or you sell the property in full. So what happens when you sell property, right? All of those losses that were suspended help offset your gain. And unfortunately, they will stay trapped until you have that passive income. So here's a few things to remember. Real estate professional status isn't a retroactive status. Old passive losses stay passive. Only a full property sale or passive income can actually free up those losses. So those are just some things to keep in mind. If you're looking to invest in real estate, there's a lot of great things to do with real estate to get some tax write-offs. However, if you don't feel like becoming a landlord or devoting that much time, there are plenty of other things that you can do to defer those taxes like you would be if you were to invest in real estate. What you're doing is deferring taxes. You're not eliminating taxes. We're all just trying to get to the point where we die. We get a step up in basis. We can pass those assets on to our kids tax-free, right? So keep that in mind as you're trying to plan your tax strategy for 2025, and you're trying to navigate the economy and the volatility of this market and tariffs and all the things that are going on. And hopefully next month we'll have some tax law updates, which is always super exciting. So if you enjoyed this episode, please like, share, subscribe. And once again, I'm Jeff Trapp with the Jeff Trapp Podcast and the Tax Planning Pros. And if you're looking to change your strategies, feel free to click on the link below and subscribe, and also sign up for a free tax consultation with our team. We can tell you how much you've overpaid in taxes and how much you can save going forward, right? A lot of times can't really change the past if you didn't move that money around in the past. But what we want to do is make sure you're on a good path going forward. Anyways, we'll talk to you again next month and have a great spring. Bye-bye.